Thank you, everyone, and welcome to this week's speaker series. I'm very delighted and honored to be joined today by David Rubenstein. David is a man who does not really need an introduction, but I'll give him a minor one. So for those of you who were living under a rock for many past 20, 30 years, David is a co-founder and still co-chairman of the board, if I'm not mistaken, at Carlyle Group. He has held various positions both in law firms and with the government, and sits on too many boards and organizations to go over. But first of all, Dave, and now he's also moonlighting as a podcaster as well on Bloomberg. I'm sure many of you have seen his podcast on Bloomberg. I know that I enjoyed very much. So David, thank you and welcome.
My pleasure. Thank you for having me.
David, so it's very appropriate for us to bring someone who has such deep and rooted experience in the private investment space. You obviously, you're well known for having founded Carlyle Group, and you've talked for many years about the democratization of the alternative investment space. So it's very appropriate that you're speaking to us now, being a private wealth manager with our focus on offshore money and ultra high net worth individuals has offshore money in the United States. Can you explain to us a little bit, what did you mean by that term, the democratization of alternative investments?
Okay. When alternative investments first came around, let's suppose in the late 60s, early 70s, when there were venture capital partnerships and then later buyout partnerships in the early 70s, mid 70s, late 70s, those partnerships were considered not appropriate for the average investor. You had to be an accredited investor, so-called, have a high net worth, be very sophisticated financially. Eventually, the U.S. government said that for ERISA funds, it was okay under the prudent man rule to now let ERISA-related funds go into alternative investments. And so you began to see enormous amounts of money coming in from state pension funds, later sovereign wealth funds, now national pension funds into this space. And the reason is that the rates of return were better than public equities and public fixed income. But generally, the average investor who may not be accredited, or even if they are accredited, they often don't have access to high net worth kinds of vehicles that often go to the wealthiest people. So what I meant by the democratization was that people that are high net worth individuals would have greater access through organizations, maybe like your own, to the kind of products that KKR, Blackstone, Bain, Carlyle, KKR might have. And then eventually, people that are not accredited investors, people that are modest blue-collar workers, maybe through their IRAs or 401ks, they also will at some point get access. They don't have it really right now, right, to these kind of products. And the reason is, it seems that the people that want and should have most access, people that may not have the greatest wealth, they should benefit from the higher rates of return that alternative investments typically provide.
Right. So how's the progress so far? I mean, you're sitting down here with us today, so right, that's one piece of evidence. But overall, what's your assessment of how that process is going on?
Well, everybody likes the word democracy and democratization, but getting there is often not as easy as talking about it. I think that most high net worth individuals by now, if they have a banking relationship or a financial advisory relationship, probably have some way to get into some alternative investments, venture capital, private equity, private credit. For people that are not accredited investors, it's still very difficult for them to get into this kind of vehicle, though I think in time they will. And like take private equity, for example, or buyouts. Over the last 30 years, in every single year of those 30 years, buyouts have outperformed public equities. So, it's unfair that people who don't have access to the buyout investing are not really getting the rates of return that they should be getting on their 401ks or IRAs. On the higher net worth people, very often ones your clients they have access to this legally, but they need to make certain that they know what's available. And sometimes they don't have access. They don't know all the opportunities that are out there because they're just not as well connected as somebody that might be a sovereign wealth fund or a public pension fund.
Right. And what frictions do you foresee with this transition? Because, I mean, one that comes to mind that's pretty evident, I think, is that, traditionally the players involved are big institutions. They have long-term horizons. They're not quick to sort of pull the trigger. But with retail investors or more retail-like investors, that's not likely to be the case. Any frictions you see there potentially?
Well, there are two different types of retail investors. Again, the retail investors who are putting in 250,000, 500,000, a million, maybe $5 million through someone like your organization, they generally are not putting in, 50 or 60 or 70% of their net worth. They're probably putting in 10 to 20% in these alternative investments. And so I don't think that's a big problem there. And liquidity probably shouldn't be a big problem for those people. They shouldn't put in 100% of their money into alternative investments. For people who are not yet accredited and not yet eligible to go into these vehicles, it's unclear what the rules are going to be. But I suspect that eventually the IRAs and the 401ks will allow, under U.S. government regulation, to maybe put 5% of your IRA or 401k in an alternative investment or a so-called illiquid investment.
Right. So David, let's shift gears a bit from talking about private investments generally, and let's talk about the current landscape. You obviously are having constant discussions and constant dialogue with many thought leaders and institutions around the world right now. Let's dive into some of the geopolitical events that are resonating most or at the top of mind worries. Let's start first with something that has potentially receded back to the American mind, so to speak, which is the war in Ukraine, right? It seems that the Israeli Hamas, which we'll get into in just a minute, is sort of taken over the front page news. I heard an anecdote the other day that CNN shifted their major bureau office in Kyiv over down to Israel because so much attention is being placed on that conflict. What sort of concerns are you seeing with the Russian invasion of Ukraine, which started back in February 2022 and now is potentially even at risk of losing some funding from the American government?
Well, if the American government doesn't come through with the additional funding that's now in Congress, I think Ukraine's chance of prevailing is very, very, very limited, if possible at all, because Europe is likely to follow the U.S. lead. If the U.S. doesn't put money in, then probably Ukraine won't be getting money from Europe or very much. I suspect some way will be found to have a compromise and get some money to Ukraine, but getting money to Ukraine is not going to solve the problem. Ukraine is massively undermanned compared to Russia. Russia has many more troops.
Right.
And as we learned, the so-called spring offensive by Ukraine didn't really budge very much.
That's right.
My suspicion is that probably by the middle of this coming year, there will be a recognition by both sides that they're kind of at a stalemate. And I suspect there'll be some kind of truce, a truce not unlike what the U.S. has in Korea. The Korean War never actually ended with a peace agreement. It has a truce demarcation line. I suspect this will probably happen. I don't say that I support this happening necessarily. I wish Ukraine would prevail, but I do think that there may be a recognition on the part of Ukraine that at some point they just can't move further. So if that were to happen, probably each side would put their arms down. And if that were to occur, then probably roughly 20% of Ukraine would then be controlled by Russia. Before the war, it was roughly 10%. So maybe Russia will have advanced by 20%, and I suspect there may be some ceasefire. But it's still a lot of issues to be resolved. Does Ukraine get into NATO? I suspect that'll be difficult. And what happens to war reparations? That's going to be complicated. What happens to the money that's been frozen in U.S. bank accounts and European bank accounts from Russia? That has to be dealt with. And are there going to be any war crime trials? That has to be dealt with. But I suspect those issues will be accelerated if it's clear, for example, that Donald Trump is going to be elected president. I think he's made it clear he's probably not a big supporter of Ukraine. So all those factors have to be taken into account.
So that scenario that you're outlining is probably one that would be cheered by investors, would be cheered by most market participants. But let's get into, just for one more question on this issue, whether geopolitically that's an out. It sounds like this is sort of what Putin has been banking on, that the U.S. and the West's attention in general will not be able to outlast Russia in a core interest in their near abroad. Any sort of worry about what precedents this could possibly set for other potential flashpoints, such as Taiwan with China or Iran with other parts of their near abroad?
Well, one of the reasons that the United States and Europe wanted to defend Ukraine was to prevent other kinds of things from happening, encouraging other people to take on these kind of invasions. I think Russia itself may be encouraged, if it succeeds in getting some part of Ukraine, encouraged to proceed against some other former republics of USSR. With respect to Taiwan and China, that's a big worry for everybody. At the moment, I do not believe that China is going to invade Taiwan in the near future. Who can predict 5, 10 years out? But in the near term, I think we are so dependent on semiconductors from Taiwan that China recognizes we have no alternative but to defend Taiwan. And I suspect for the foreseeable future, I would be surprised if there's an invasion there. That'd be my guess.
That's right. And the Chinese also don't have a way to supplant these semiconductors that are coming out of Taiwan. So that I think that's a very salient point. Let's shift over to the conflict in Israel, in Gaza. I think also, at least from investors' perspective, this is also sort of receded from the forefront of worries. We see oil has basically retraced most of the gains that they had post the invasion. How do you see things playing out there? And let's maybe talk perhaps about what the end game could be for Israel, because I'm pretty sure that no one in the Israeli government wants to become a formal occupier of Gaza, correct?
Correct. Nobody wants that anywhere. The issue is, can you really eliminate Hamas? It's not easy to do. As the United States learned, we didn't really eliminate the Viet Cong. We didn't really eliminate the Taliban. So it's eliminating a whole military force is not that easy to do. And so it's not something that I think Israelis really think will easily be done. But for the foreseeable future, Israel wants to make as much progress as they can in destroying the Hamas military machine. Ultimately, I suspect there will be another proposal for a two-state solution with respect to the Palestinian issue, but it's not, that easy to do. When I worked in the White House for President Carter, and that's like 40 some years ago, there was an agreement between Israel and Egypt, but there has never been a Palestinian agreement. President Clinton came close to one, but didn't quite get it at the end. And right now, I'm not sure anything can get resolved that quickly. There are too many complicated issues as to who's in charge. Is it Hamas or is it the PLA? What happens to the settlements in the West Bank and all those issues? I don't expect it'll get resolved anytime soon.
Is your base case that the war sort of remains limited to Israel and Hamas directly? What sort of odds do you put for it escalating and involving, perhaps Iran or other actors within the Middle East?
For the foreseeable future, it appears, everything could change tomorrow, but it appears that Iran does not want to get involved in a military confrontation directly with Israel, and that Hezbollah has decided the same thing. So I think Hezbollah is more or less not the biggest problem, and Iran is not the biggest problem at the moment. And I suspect an intifada in the West Bank is not the biggest concern. I think the biggest concern in the Middle East, other than this war, probably is what's going on in Syria. And with respect to the attacks now going on American troops, that's a big concern as well. But I think right now, I don't think that the U.S. government feels that the war is doomed to escalate or is certainly going to escalate. It could, but I don't think that's what people currently think. I think it can be reasonably contained.
Right. And okay, so then this next point will be our final geopolitical point, and then we'll move on to financial markets. The U.S. election, I think everyone has a pretty deep sense, or I think the correct sense, that it's a very seminal election. The country is very polarized. We can probably expect clashes or civil unrest regardless of who wins, with ramifications potentially for our allies and other parts of the world. How do you see the U.S. election shaping out? Will it be Trump? Will it be Biden? Obviously, the most likely two candidates right now. And how do you see the chances of either coming out victorious?
Well, today, I think it's fair to say about a year out that it's hard to predict who's really going to win. If you were to predict who the president of the United States is going to be a year in advance, the last 10 presidential elections, a year in advance, you'd probably be wrong every time. So there's always events that occur that aren't anticipated. If the election were held today, it's clearly going to be very close, and it could be decided by the third-party candidates, because you've got maybe 3 or 4 third-party candidates. When Al Gore ran in the year 2000, he lost Florida by 539 votes. I think Ralph Nader got 80,000 votes in Florida, and presumably most of those votes would have gone to Al Gore. Right. Third-party candidates are going to have a big role, and the election is going to be very, very close. Right now, I think Donald Trump is likely to win all the states he won last time. I don't see any big fallback from his support in those states. And the states that Joe Biden won, they're going to be close. There's no doubt about it.
And which outcome do you think markets would most welcome?
Well, it's hard to say because there are U.S. markets. I suspect U.S. markets, what markets most like is certainty and predictability, and they don't like uncertainty. So what they probably would like is somebody to win in a decisive way, so we know which way the government's going, and maybe that'd be true in Congress as well. While divided government actually produces higher S&P 500 returns, it turns out, over many years, most people would probably like to see the government go in one direction or another, and at least we have the certainty of knowing where we're going. That's probably what markets want more than anything else. They don't want uncertainty.
That's right. That's right. So, we know that, it'd be very difficult for a sitting president, historically speaking, if you look at the data, to get elected with a recession on the cards. If that finally does come to pass, a person who's, whether he wants to or not, is going to be largely, or could be, responsible for either averting or having one is Fed Chair Powell. Some of you may not know, but David actually hired the current Fed chairman at Carlyle at one point. So he probably has as good of an insight as anyone out there as to what the Fed chair could possibly be thinking. Let's talk about the Federal Reserve. A question that comes to mind is, has the Fed overdone it on rates? We've seen the quickest, fastest hiking cycle really that we've seen in the last 40, 50 years. Talk about a little bit about what's your view as to how the Fed has handled this most recent inflation crisis.
Well, I think at the beginning, the Fed thought it was transitory, and the Fed now recognizes, and everyone recognizes, that the Treasury view and the Fed view that it was transitory was wrong. But once they recognized that was wrong, I think the Fed has done a very good job of increasing rates at a tolerable rate. Now, for example, think about this. We've had 11 rate increases. We haven't gone into a recession. And I think the conventional wisdom today is that we probably won't go into a recession. We're likely to have a soft landing. But of course, the markets are assuming there's going to be a Fed rate cut sometime or relatively early next year. Right. I think the Fed is worried about going into the next year and doing a rate cut very late in the year, because that's in the political season. In other words, the Republicans will be very upset if you have a rate cut in June or July as the first rate cut. That would presumably propel the economy forward, helping the Democrats. So recognizing that, I suspect the Fed may want to put its toe in the water of rate cuts earlier than that. And there are some investors who are now betting that will occur. I don't think anybody knows for certain, because the Fed is very data driven. It's not as ideological as you might think. They really look at the data, and they don't really know what the data is going to be until right before they have their meeting. So right now, it's probably early to predict when the Fed rate cut is going to be, but I suspect it'll be in the first half of the year.
Right. I was at a conference in New York recently where some of the participants who also are familiar with some of the inner workings of the Fed were mentioning that the Fed's pivot was due to Chair Powell not being an economist and actually being a lawyer, because all the economic models predicting inflation to be transitory were quite wrong. So that might have been a blessing in disguise. Let's talk about the Fed's rhetoric has been sort of, let's say, suggesting that the Chair Powell wants to be more remembered as Paul Volcker instead of Arthur Burns, right? So there seems to be sort of an institutional bias in the Fed not to sort of get behind the curve again, inflation, not being wrong in the same direction in the same cycle. Do you think that that's valid? Do you think the Fed is more worried about inflation reasserting itself rather than perhaps potentially at worst causing a mild recession?
I think the Fed does not want to be flip-flopping. It wants to have a steady trajectory up and a steady trajectory down. Right. One of the things that Jay Powell has done that I think is good is he usually tells you what the Fed is thinking, and he's thinking before they have a FOMC meeting. And after the FOMC meeting, he actually explains it in fair detail. You may remember that in the old days of William McChesney Martin or Arthur Burns or even Paul Volcker, the Fed didn't hold press conferences right after their FOMC meetings, and you had to figure out from the market what they were really doing. Now I think it's much better that the Fed tries to explain it. And because Jay is not an economist, he speaks in not Fed speak, but speaks in English. People understand what he's saying. And I think that's a big plus.
Right. And one last topic on the Fed, and then we can move on. The 2% inflation target, the much ballyhooed. We all know that there's nowhere in the economic literature that says that 2% is a magic number. That sort of has been just kind of glazed from what the neutral rate of interest is in the economy in the United States. Is that 2% inflation target still realistic given the current state of the U.S. economy? Is the neutral rate higher? Does it have to be systematically? So what's your view on that?
Well, the Fed doesn't want to look like it sets a goal and then doesn't meet it and then does what it says it's not going to do. So the Fed has said 2% is their target. But I don't think the Fed has said it has to be at 2% for a certain period of time before they're ready to rate cut. It could be they could say that 2% is within reach now, 2% is nearby. And so there might be some wiggle room there. But I think the Fed is not going to say, well, we're now at 4%. That's good enough. I think it has to be that 2% is seen as somewhat realistic as being in the near term as possible.
Right. So what's your view for let's say the forward path of interest rates for the next year? I know obviously this is very difficult to predict, but I'm assuming at Carlyle you have a house view. Maybe your view differs from the house view. Sort of give us your sense right now. The market, if you look at, I checked Bloomberg just before coming on here with you. The market's pricing in roughly 100 basis points or so of rate cuts, slightly more. So the market thinks the Fed funds rate will be roughly at 4% by the end of next year. Does that sound right to you, or is that a little bit too aggressive?
I'm not going to put a number on it. I would say that the Fed wants to go in a steady trajectory. They don't want to flip-flop, have a rate cut, and then they have to have a rate increase. They want to make certain before they do rate cutting, they know that it's very, very unlikely they're going to do rate increases. And as to when the rate cutting will occur, I think that there was a view a couple of weeks ago that Jay Powell was signaling that was going to happen sooner than later. He then made a statement more recently saying, don't assume it's coming so soon. I think right now people probably expect something in the second quarter, just because once you get in the third quarter, you're dealing with the political season.
Right. David, so this will be the last question on the economy and the Fed before we move back to private investments. You're well known to have spoken over the years about the national debt and the trajectory of the national debt in the United States. According to the CBO itself is projecting deficits north of 6% over the next 10 years. Obviously not in recessionary scenarios all the time. So that very atypical for that. Talk to us a little bit about can the U.S. get its fiscal house in order? Because from where we're standing, I can tell you from investors' perspective, we're seeing that there's no appetite for any fiscal discipline, either from the Republicans or the Democrats, really.
Well, you can only solve this problem one of 5 ways. You either start cutting spending, which means cutting entitlements, which is very difficult to do.
Right.
You increase taxes, another thing it's not easy to do because all the revenue really comes not from the high net worth people. There aren't enough high net worth people. You have to go to the middle class, and that's more politically difficult. Those are difficult steps. The third way is you go to the IMF and said, whoops, sorry, we made a mistake. We need a bailout. That's obviously not realistic. The fourth way is you say, we're sorry, we default. We just can't honor all the debt. That's not realistic. So you have the fifth way, and that's what we're pursuing, which is basically inflating your way out of it.
Right.
So basically, we're going to devalue the dollars and pay this off. Your children and grandchildren and great-grandchildren of mine will pay off this debt. To remind everybody, we have $34 trillion of federal debt. It's about, 120% or so of GDP. It's just as high as almost any country in the world. Maybe Italy's higher. And Japan is a unique circumstance. They're somewhat higher. But it's not tolerable or sustainable over a long period of time. But right now, the markets have been willing to sustain it. It wasn't such a bad problem, relatively speaking, when interest rates are at 1 or 2%. When interest rates are at 4 and 5%, it costs the federal government a lot of money. We're spending almost as much money on interest as we're spending in the defense budget. And that's not sustainable over a longer period of time. Right.
So this stealth monetization that you're really referring to obviously works if inflation is somewhere north of 2%. It doesn't work at 9%, so that was intolerable. But, what's sort of the sweet spot you think here where this stealth monetization that you and many others are speaking about is tolerable, let's say, from not just the U.S. consumer's perspective, but also from the institutions like the Fed, right? So at what point will the Fed abandon that 2% inflation target, for example?
Well, when I left the government in the Carter administration, obviously inflation rate was in double-digit numbers, and that wasn't tolerable. Paul Volcker began the process during the Carter administration, ultimately got us down to a point where for 25 years in the United States, the inflation rate was 2%. And so I think the Fed, to some extent, says we want to go back to where we were before people worried about inflation. My children never lived through inflation until this period came along. Right. I don't know whether we need to go back to 2%. When I was in college, the standard textbooks on economics would say that the normal inflation rate in a Western economy was something around 3 to 4%. So, 3%, 3.5% is tolerable. 2% is better. I don't know if we have to get to 2% so quickly. And again, we're assuming that we're not in a recession, which would lower the inflation rate presumably a bit. And we're also assuming we're not having a global catastrophe of some type that would increase the inflation rate. But assuming no recession, another war, probably somewhere between 2 and 3% would, when the Fed sees we're there, I suspect you'll see rate cutting and continued rate cutting until they get down to, something like a more normal Fed discount rate of 1 or 2%.
Right. So those are the levels that you think would be tolerable and would, that makes sense.
Yes,
so
but the Fed is not going to go down to zero interest rates again. I think the Fed thinks that was probably a mistake for a number of reasons. So I suspect we want to have an interest rate that's more normal.
We agree. We think, obviously, and from what you're saying, probably makes sense that an environment where rates are systematically higher makes sense and is most likely the likely outcome here over the next several years. Let's switch back to the private investments world here. Let's talk about private equity, which is obviously near and dear to your heart. And then maybe we could make a few comments on private credit before I turn it over to any questions from the audience. So on the private equity side, I can tell you Insignia as a house, we've been underweight private equity. We've been overweight private credit. So we can talk about that in a minute. But on the PE side, we've seen a lack of deal flow. We've seen a lack of companies out to market. Obviously, the sort of the obvious answer to that is like, well, yeah, rates are higher. People were demanding higher exit valuations, and potential buyers are looking for lower valuations to come in, right? First of all, do you agree with that assessment? And if so, because you think and many others that we're going to be in a higher rate environment, is this going to be something where this is going to be a poorer environment for private equity than we've seen over the last 10, 15, 20 years?
Well, it may not be as good as it has been in the past, but still probably better than other alternatives. I think the problem in finding deals and the reason deals aren't getting done is that sellers, when they pro forma the deal to do the deal, would say, well, we're going to make 2.5 times our money.
Right.
And so if you now can sell it at only 1.5 times or 2 times, it means you're not getting what you thought you were going to do and what your investors expected. And that's a problem because a lot of people think the world will get better and they'll get a higher rate of return if they hold on. The buyers, by contrast, are afraid they might be buying into a recession. So they don't want to pay a price that seems a little high and then we go into a recession. They don't want to look like fools. So there's a gap, I would say, of 10 to 15% between what buyers and sellers are on pricing of most buyouts. And obviously some buyouts are getting done, but a lot of them are not getting done because people are concerned about we might go into a recession or concerned that the price being paid is much too high in the case of buyers, and the sellers are worried it's not high enough. Right.
And no one wants to, buy in and deploy capital right before we enter a recession, right? That would be the worst time. So
people don't want to look silly. You buy a company and the next day you go into recession practically. That looks bad.
Of course. So we've talked about private equity in general. Any pockets within the PE world that you do find attractive where it is an interesting place to deploy capital right now?
Well, mid-sized buyouts are actually still pretty attractive. They're not the gargantuan ones that get headlines, but they're still reasonably good. I think in Japan, Japan is a really good market right now, and that's one where I think you'll see a lot of buyout activity. I think technology-related buyouts in Europe, I think, are going to be pretty attractive as well. In terms of technology, I do think you're going to see a fair amount of money put into certain venture areas. Obviously, AI, that may be a bubble a bit there now, but quantum computing is going to see a fair amount of money. Computational biology, CRISPR technology, things like that are going to see a fair amount of good deal activity, in my view. And I do think that generally there's probably a reasonably good business to be found in manufacturing. Some manufacturing opportunities are pretty good as well. So there's opportunities there. There's always going to be some opportunities.
That's right. Do you have a forward projection for what 10-year like annualized returns could be like in the PE space? Either
well,
Carlyle,
it's hard to say. I would just say it's hard to say. I would just say that historically, people went into private equity or buyouts. Let's just use buyouts, expecting to get, I would say, about a 20% net internal rate of return. In recent years, the net has gone down to maybe 15 to 16% because there's more. Prices have been more expensive and more competition and bid prices up. I would say most large institutional investors, the largest ones, because they have to put out so much money and they therefore can't be as picky in the funds they go into. They might, be happy to get 13%, 14%, 12% in their overall buyout portfolio.
That's right. So let's shift over to private credit. And before I do so, I just want to remind everyone that if you do have questions for David, please submit them either here in the chat or to me directly, and I'd be more than happy to go over them with him right after or in just a few minutes. So let's shift over and talk to private credit. In our view, we've been overweight as a firm. Private credit, we've been advising our advisors to deploy capital in that space right now. Do you share that view, or do you have a different view right now?
Well, private credit has been a booming recently because interest rates are high, so you get a higher yield on these kind of instruments than you would otherwise get. At some point, as interest rates come down, as they will inevitably the next year or so, private credit may attract less capital than it did before, but I still think it's a pretty attractive area in which to invest in because the rates are still going to be pretty attractive. So I think private credit is probably a bigger business than private equity in many ways, and it's probably not going to shrink all that much.
Okay. Are there any pockets, let's say, in private credit that you think are perhaps perilous or perhaps looking a little rich right now? We have seen a lot of money in this space go into that space this year. So any sort of potential potholes there? I'll kind of throw the reverse question of the private equity question, right?
Well, you don't know you're in a bubble till the bubble is burst, so it's hard to say.
Right.
I would say there's a lot of money that's gone into private credit from large institutional investors. I hope they are cognizant of the fact that the market could be a little saturated at some point. But generally, I still think private credit is a place where I put a fair amount of my money as well. And I do think that the returns are likely to be reasonably steady compared to other fixed income instruments you're likely to get.
Okay. Well, thank you so much with that. So let's just end with, let's move away from the geopolitics and the markets and the private investments. I know that and go to things that perhaps could be near and dear to your heart. I know that you are very much involved in philanthropy. Like I mentioned before we started the call, you're a member of too many boards to really mention here. We would be here for about 30 minutes. Could you elaborate as to why is it so important for you to be involved in philanthropy besides the obvious,
Right.
that you're doing good for the mankind? Like, why is this such an important part of what you do specifically?
Well, I came from very modest circumstances. My parents were not college or high school graduates. I'm an only child. I got very lucky. I got scholarships that helped me along the way. And I feel an obligation to give back to the country. And many of the things I do is what I call patriotic philanthropy, trying to remind people the history and the heritage of this country. I just feel that, what are you going to do with the money? You can either give it to your children, where there's not evidence that produces necessarily better human beings. You can build big monuments to yourself. That necessarily doesn't always, work so well.
Right.
Or you can give it away. And I think it's better to give it away to good causes when you're alive more than when you're dead. Though giving away money upon your death is what most people probably really do. I'm very active in this area, and I enjoy it. I get a lot of pleasure out of it. I like to remind people that philanthropy that word is derived from an ancient Greek word that means loving humanity. It doesn't mean rich people writing checks. And you can, by helping with your time, you can make more money if you're inclined to do so. You can't make more time. And so I think the most valuable thing one can do is to give their time. And I encourage people who are listening today to think about what more they could do to give back to their country or to their community than they've done, so that they can be a bit of a role model for their own children and their grandchildren. And so at some point, your children will say to you, I'm proud of what you did with your life. You didn't just buy big houses and lots of airplanes and boats. You did something that gave back to society. And I think it's a very fulfilling thing to do with your life and your time.
That's a great answer. And it's funny that you mentioned rich people writing checks, because I have a question here, which I'll give to you in just a minute, precisely about this topic right now. But before I get to that, one last question from me, and then we'll go to some questions from the audience. So in your book, How to Lead, you have this part where you mentioned that it's common to find true leaders that come from humble beginnings. What's the reason for this? Obviously, you sort of just mentioned that you come from humble beginnings yourself, So you probably have a natural sort of attachment to this, but what's some of the evidence that you have seen throughout your career? Because I'm sure you're just not going on your own example, right? I'm sure you've seen it throughout. So let's talk about that a little bit.
Well, as a general rule of thumb, obviously there's always exceptions to every rule of thumb.
Of course.
If you grow up in an extremely wealthy family, you may not feel you have to work hard to prove yourself. You know you can fall back on your family's money or other resources, and you may not have the drive that you want to that makes people successful. Now, there are some people that come from wealthy families that have done great things in life, but very often you see people from middle class or blue collar families being the ones who are changing the world, who are making a real difference. There aren't that many people whose fathers were in the Forbes 400 or their mothers were in the Forbes 400 who then went out and they made a great fortune themselves or did something great for society. There's obviously exceptions, but as a general rule of thumb, you tend to find the people who are leaders coming from more modest circumstances.
Excellent. So much, David. Appreciate that. So now let me go to some questions from the audience. I have a good mix of financial questions and more personal questions, I guess, or more topical questions. So I'll just ask you a few because we're here just a few minutes over. So one question I do get is that what do you tell investors that are concerned that in this democratization of private investments that they're going to get watered down somehow, or that they're not going to get the full benefits of private investments at the institutional level, but yet maybe watered down with some of these, perhaps, let's say, more liquid strategies that then will not allow investors to partake the full gains of, well, full private equity or private credit cycle?
Say watered down because other people are coming in, or because there's not as, well, is that what you mean?
They didn't specify, but let me add here. So one reason could be because there's a lot more money going into the space, so you would expect, right. A bit of an arbitrage there.
I understand.
Right.
Well, yeah. Sure. If more money goes into the space, almost by definition, price will get bid up a bit, and then valuations will come down. But you have to be realistic about valuations. If you always think you're going to get on your money 25% rates of return, you're going to be very disappointed. I think people should take a realistic look at what kind of rate of return they should want overall on their money, and get good money managers to help them. And what I've said in my book on how to invest is the most important thing people should do with money is get somebody to handle it who knows what they're doing. I think I'll look at the fees that they're being charged, make sure you understand them, make sure you can get information on the investments when you want them, make sure that people have their own and don't have conflicts of interest, make sure the people that are investing their money are people that have a lot of experience in doing exactly what you want them to do. So picking good money managers, in my view, is as important as anything in investing your own money. Trying to do your own deals or invest your own money is very often a fool's errand.
Right. And in this space in particular, being invested in the top managers obviously makes all the difference in the world. David, one final question here. I have a question is, what is your prediction for the election outcome, not just in terms of the presidency, but also in terms of the House and Senate? Because that's obviously going to change the dynamics quite interestingly, right? It's not just about the president here; it's also about the House and Senate.
Yes. Well, on the House now we have two Republican members who've left. Santos is gone, and McCarthy is going to step down. So that would give the very small majority to the House Republicans. I suspect now, based on some redistricting and other things, I suspect the Democrats have a reasonably good chance of picking up the House, but I also think the Republicans have a reasonably good chance of picking up the Senate. The Democrats are defending, I think, 23 seats, I think it is, are up for election. Democratic seats are up for election. That's a lot to defend. And they have a number of senators who are in so-called Trump states, and they may be difficult to get reelected. I think the Senate is probably more likely to go Republican, and the House is more likely to go Democratic. That's the current views. Things can always change, but that's what I suspect is going to happen. On the presidency, it's too close to call.
So it's truly a 50-50. Do you expect there to be more civil unrest no matter who wins?
I hope not, but I don't know. I mean, the country is clearly divided, and I think we need to recognize that, it's not a pleasant situation. I think the biggest danger facing the United States right now is not overseas, but it's ourselves, and it's our dysfunction of our government in many ways. And that, we used to be a role model for people around the world who are democracies, and we were losing that a bit. And it's hard for us to go overseas and say, we have a great democracy. Listen to how we're running our government. You should run your government that way. We're losing that ability.
Yep. Yep. Well, thank you so much. So before I end, I just want to say, as many of you already know, we're working very closely with Carlyle on some of our offerings here, specifically their new 40 Act registered private credit interval fund, which is called the Carlyle Tactical Private Credit. This is a multi-strategy private credit fund that's been yielding quite attractively here. And I want to point out that it's available for both onshore and offshore clients through the iCapital and Case platform. David, thank you so much for your time.
My pleasure.
Were very
Thank
generous.
you for having me.
It was a pleasure speaking to you, and hopefully we can do this again. And have a great trip down to Florida.
I will do that. Thanks a lot. Good day. Bye.
Bye-bye. Insignia Financial Group, LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignia International Financial Services, LLC, headquartered in Puerto Rico, and through Insignia Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignia Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignia International Asesores de Inversión Uruguay, SA, Insignia Asesores de Inversión Latam, SRL, and Insignia Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignia Argentina, SAU, and in Chile through Insignia Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignia Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignia.com/disclosures/ or via www.finra.org. To learn about Insignia Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Advisor Public Disclosures website, https://advisorinfo.sec.gov/.